Steve, just set this up for us. Consumer confidence dropped this morning. Not a great sign.
I think you set it up perfectly, Kelly, with your producers here. You started off with the two big issues that are affecting the economy. You got the UAW strike, you have the government shutdown, and then you added the higher oil prices in your lead-in. Those are all three challenges that are coming for the economy. They're coming for the Federal Reserve. I think without the higher oil prices, the Fed at this juncture might have offered some relief last week, and I think it's a bit of it in a box right now where these high oil prices create a huge challenge for the Fed, where they can't really afford at this point to take their foot off the brake of the economy because of the concern about how high oil prices could potentially reignite inflation here. So it has to remain tough, even though there's a lot of signals in the economy, including what you just mentioned, Kelly, the consumer confidence number that suggests maybe the Fed ought to be easing up here.
All right, Dean, a perfect time to have you back on. And it's been a while since we've checked in with you. It's not every day we get to hear from someone who is most accurate forecaster 2 years in a row, or you have to remind me exactly what the designation was. My sense is you're not quite as bearish as some on the U.S. economy. You've been a little bit more constructive for some time. Do you remain optimistic now that we can avoid a recession if that's your base case?
I do remain optimistic. There's a couple of reasons for it. We've had these recession fears for over a year now, and over those 4 quarters, growth has been 2% or higher every time. And we think growth in the third quarter is actually going to be 3.5%. So there are some headwinds imminent, as you mentioned, but I think it's worth highlighting that the economy did have a lot of momentum coming into this. Now, each of these pieces, the auto worker strike, the shutdown, they will chip away at growth in the fourth quarter. And we think growth in the fourth quarter was going to slow down anyway from that 3.5% pace. But these do seem like they're likely to be somewhat temporary forces. They shouldn't last for months and months and months. And we think that underlying resilience that got us these 5 straight strong growth quarters still remains there.
What do you think? I mean, this isn't necessarily part of what where you want to go, Dean, but when you hear Jamie Dimon talking about 7%, is that kind of interest rate feasible? And would it negate everything that you just said? Or do you think the economy could still withstand it?
So I don't think it's crazy what he said in terms of, interest rates eventually possibly going much higher. It's not our base case. We think that, and really it comes down to the inflation outlook. We think that inflation is going to settle down over the next several months and is going to be enough to get the Fed to stop hiking rates. So we actually think the Fed is finished hiking rates right now. The only way that is not true in the sense that the Fed has a lot more work to do, as Mr. Dimon suggested, would be if inflation really starts taking off again. And then I think at that point, the Fed would be willing to cause a recession. And I do think raising rates to those kind of levels would cause a recession. So it's not a far out scenario, but it's not our base case.
Steve, I'm glad you're here today because, I always like to bandy about sort of odd new ideas. And I have a new one, which is, does the Fed need to get hawkish again in order to crash bond yields in the longer term, right? Like, I can't figure out how we get out of this debt and deficit situation unless the 10-year goes way back from 4.5%, forget 7%, and goes to something more like 2 or 2.5 again. And I don't see how that happens without way low inflation or, a way more slow economy.
Yeah, and just a warning to viewers, folks, Kelly and I are going to chat, and you can just listen here how we're going to do this, because I had the same question, Kelly. And the deal is this. I remember throughout a lot of this period, the long end was lower, in part because it was banking on a recession. And I'm confused as to why that hasn't happened now.
Right.
And I think what's happening right now is the long end is reflecting 3 things. One was, first, it was higher growth. Second was greater issuance. And the third is perhaps baking in more inflation and inflation compensation. I think all of those things are playing are factors in why those long ends are higher and not doing what you and I think, both expect them to do, which is to reflect a greater chance of recession. On Dean's comments, I think of the soft landing as one of those, like, I like to watch a lot of sci-fi stuff, and they talk about how a ship has to hit orbit at exactly the right place or it goes spinning off into space. I think that the window for that soft landing has been a narrow one. And the idea of these 3 or 4 things we've been talking about, accumulating one on top of each other, I think they make it potentially difficult to hit that soft landing unless the Fed eases back.